Simon Michell from FIIG with some fresh insights for you. Warm welcome to you. It was interesting, isn't it? Because you're getting this inevitable pull down, as it were, on what's going on with currencies just because of the dollar. The greenback, as it were, trapped, as one analyst has said, by the back and forth of rates. You know, you've seen the 10-year finding some support around 2.5%. Are you saying we have seen the bottom for yields and for the dollar, or there's still more to come?
Look, that's the big unknown, I think. I mean, obviously touching year lows this week was interesting. I think domestically it was driven a little bit by people just working through the budget and the likely impact on that on growth moving forward. You know, the RBA minutes of their meeting indicated that domestically growth could be a little bit below trend because of fiscal consolidation. So, yeah, there's been a lot of talk about that, a lot of speculation. So I think that caused a bit of nervousness in the market, and you know, yields were falling on the back of that. And then, of course, we got that good PMI data last night. Obviously, equity markets had a good day yesterday, so we've seen a bit of a reversal of that as bonds weakened and people look to take on a bit more risk.
What have you made of that volatility so far in the month of May, both on the 10 and the 5-year? That range that we've seen, how standard is that, or how unusual, by contrast, might it be?
Look, it is unusual, but I mean, there has been a gradual trend through the entire year since January that rates have just been falling in the long end of the curve. I mean, the talk's been about rates moving higher, but the actual fact has been longer yields falling, and that's why bond markets have performed so well for investors. I think you know, the volatility does reflect that we're getting to the bottom. You know, we are seeing a little bit more movement up and down. Look, credit spreads have narrowed substantially as well, but they're also starting to get a little bit more volatile. They were up a little higher overnight too. So, you know, I think, you know, while the market works its way through, you know, the decrease of stimulus globally, you know, there'll be a little bit more volatility, and I think that reflects that we are getting to the bottom point.
What did you make as well? It was quite interesting, the indirect bids, so the foreign investment component of that tip auction in the United States. There was a 13 bill 10-year on these inflation-protected securities, and that would tell you, would it not, Simon, that there are inflationary impacts to come, at least from what foreign investors are saying, even if it's later rather than sooner.
That's right. That's right. And I mean, you know, we're seeing that globally as well. And, you know, you would expect that in the lead up to rates moving higher. Obviously, you know, sovereigns around the world need to get some positive inflation into the markets before they can look at moving rates higher. So it is a focus. I see that there's, you know, a big demand for global inflation-linked bonds. Look, we've been pushing inflation-linked bonds for a couple of years. You know, obviously, our domestic inflation here is drifting up to the top end of the band, around that 2.93%. You know, I think in this market where rates are likely to move higher, that is likely to be on the back of higher inflation. It is, you know, important to have some of that exposure in your portfolio, just to provide that protection in a low rate environment as we have now.
Okay. If you had the choice, would you be dipping your toe into the Greek sovereign debt market now, or eyeing off UK banks? Because Fitch and S&P took a view, quite a positive one, on both overnight.
That's right. So Fitch has upgraded, or likely to upgrade, Greece's long-term bond rating from B- to single B. And Standard & Poor's, I think, came out and just affirmed the ratings of the top 10 UK banks after a reassessment. That's all pretty positive, and it flows into that positive view and sentiment we're getting out of the European market over there. Look, we do expect some stimulus from the ECB at their next meeting. They've certainly flagged that. I think the markets will be disappointed if they don't get that. But I think that the rating movements reflects the improvement as we sort of, you know, get a bit more time under the bridge of banks recapitalising, repositioning, the market improving, and working through some of those issues that led to the huge declines.
Okay, how do you profit from this new home sales and private sector credit data domestically?
Yeah, look, I think it'll be pretty steady as she goes. You know, we're not looking to any great movement. I think it's going to be pretty you know, pretty benign, the home market. I think we've seen probably the most of the surge. I think it's going to be pretty steady now. Investors are getting settled into a fairly neutral rate environment. You know, I think that home sales are likely to continue at fairly sort of a fairly flat line, essentially.
You're not of the view that maybe there could be some pressure now on further easing from the RBA?
Look, I mean, I think that was certainly an issue that we looked at on the back of the budget. You know, what impact was that going to have on growth? How much money was it going to take out of the economy? But I think when you look at the assessments of the impact on GDP, it's really quite low. And, you know, there's been a bit of commentary in that in the newspaper as well. People suggesting it should have been higher. Most of it's been pushed out for a few years. So in the immediate term, you know, it's not likely to have a bit of an impact. And I think from the RBA, you know, although their comment that growth is likely to be below trend, you know, I think they're pretty happy with the outcome.
Yeah, and with an unemployment rate that would peak in their eyes at about 6.25%.
That's right, it's a little lower than they were suggesting only a couple of months ago. So, you know, they're all positive signs.
On that positive note, we'll leave it there. Simon, thank you so much.
Morning, Carson.
Have a great weekend. Simon Michell from FIIG. Coming up after the